So I have 4,000 on gold. I can't remember whether when we talked last time I was there, I had been at 3,400 and
Mm.
raised it sometime in last year. So I raised it to 4,000, and I think we've been consolidating since April in a sideways consolidation. We're very close to breaking out of that, and I think we're about to. I think we'll see it in September, um, and have another nice run, probably to 4,000 in the last 4 months of the year. Um, Silver, I have a 75 target that I've had for a long time.
You have made some what seemed at the time some very wild calls, and they have come to pass. Now, you've actually reviewed those calls, revised them, and you think that the extent to which markets could get extended is even greater than you previously considered. Before we dive into that, um, what are your big calls at the moment, and then we'll dive into exactly what's driving that.
Yeah, so I have raised targets on all my market indexes. So in my last letter back in July, I raised my S&P target to 8,700. So I mean, I think there may be 7,000 targets out there, but they just recently brought their targets up there. Most people were in the 64 to 6,600 area, and some not even there. And as you know, last April they all thought the bottom was going to fall out of the market. So I actually raised my target to 8,000 back in April at the bottom. When everybody was getting more negative, I was getting more, in my contrary way, more positive. The sentiment had gotten so negative. And then when I took a look in July, my analysis just said you're not high enough. So I raised it to 8,700. My NASDAQ target I raised to 30,000 from 27,000, which had been raised back in April. And then I raised my Dow target to 60,000 and my Russell target, which was pretty extreme already at 3,300. I raised another 100 to 3,400. Um, People think I'm a moving target. No, it's just when the analysis suggests that I'm still too conservative, I'll raise my numbers. So they do seem extreme at the time that I put them out, but I'm looking forward, not backward.
Okay, I'm going to be a bit cheeky here and say, are you a contrarian for the sake of contrarian, or do you just want to have the highest target that's out there in the market to draw attention to yourself, or what really backs up your calls?
Yeah, I'm not that at all. I have said many times, I'm the first one to tell you my forecasts are extreme. They're extreme because that's where we are in the super cycle, or that's where we are at the end of a 43-year secular bull market when things do go to extremes. So it may look like I'm just trying to draw attention, but that's not at all the thing. And that's why I actually don't don't go to where I end up initially, because even for me, I can't go that extreme. So even if I think things are going to be higher, I go to where I think I'm making a reasonable bet. And then as the time goes on and analysis suggests I should, then I'll raise some more. But, I'm already so far outside everyone else, whether it was back at 6,000 or 6,500 or, 7,000, that even I try to temper what I actually think it could go to. So but I am, in fairness, I am trying to sincerely put out what I think is going to happen. I'm not trying to play games. I'm not trying to get more eyeballs or attention. It really is. I'm a contrarian because I understand sentiment, and I've spent 52 years studying it. And at turning points, I'm very contrary. At times like this, where everybody's starting to jump on board, I'm not so contrary. I mean, I'm contrary in my numbers, but people are getting more bullish, and that doesn't mean I get bearish.
Yeah, and there are a lot of people that are making bullish calls out there, but yours are on the extreme end. So
Right.
the question to you then is, what are you seeing that other people are missing then that makes your calls so much more bullish in most instances than other analysts?
Yeah, like I said, I'm driven by sentiment. I use fundamental analysis, technical analysis. I put a lot of pride in my macro. I think I'm as good a macro analyst as there is out there. I've been doing it for a long time. I think I'm as good a contrarian as there is out there. I'm not afraid to be away from the crowd. So I think a lot of times the numbers kind of congregate around a mean,
Mm,
because I don't think people are comfortable going too far away from the crowd,
mm.
and that doesn't bother me at all. I'm most comfortable when nobody agrees with me, so that's part of it. But I mean, it really does come down to what I see out there, and it's come from 50 plus years of doing this. I mean, I've called cycles over time, and I'm not trying to be different than everybody else. I get when everybody starts sounding like me, people wonder, they go, "You're not really contrarian." I said, "Well, there are lots of times I'm not. I'm not. I'm just going to go with what I see in my analysis."
Let's talk about the stock market then, just as an equity or as an asset class rather at the moment. There's been some interesting moves in the stock markets this year, and as you pointed out, back in April we did see what we thought was going to be a much deeper bear market correction, but here we are again now touching on all-time highs. Your call for the Dow is significantly higher than where it is now. What's underpinning that? How?
How do we get there?
Yeah.
So I think what we're going to see, and it's starting to happen, as I've said for a long time, from basically 2022 up, from October 2022 bottom down at 3,500 on the S&P, and I don't remember where the Dow was, but from that point forward up until very recently, and even now, most of Wall Street was skeptical. Retail did better in April. They didn't fall for the head fake, and they stayed bullish and they bought generally. So a lot of retail got scared, but generally the retail did better. Institutions got bearish, and they've been skeptical of this market all the way up. They keep looking at valuations and thinking valuations are at peak levels and they can't go much higher, and et cetera. What we're seeing is obviously because of AI, but also other things, the companies have done a great job in an environment that wasn't that easy to keep pushing the earnings higher. And, I saw that. That was part of my thesis. I also think people are way too bearish on the bond market, on interest rates. And I think, in fact, I'm very bullish on bonds and think rates are going to go a lot lower. And that's different from, I think, the street.
On the short
Um,
end or on the long end? I mean, we're obviously
both,
we've
both.
obviously seen the last couple of weeks, particularly with Powell's speech at Jackson Hole, we've seen that there's kind of a bit of a capitulation in the Fed, and it looks like the White House is going to have more significant influence over the short end of the yield curve. So we are likely to see cuts where we weren't necessarily pricing them into that extent previous. So that bring the short end of the curve lower. But the long end of the curve, particularly, and it's not just the US bond market, but we're seeing this across the globe, the long end of the bond markets, the yields are going significantly higher. Do you think that's extreme overdone and will reverse?
Well, I'll speak to the U.S. You guys over in the UK are dealing with something different, and I don't follow close enough to know. I commented yesterday, and somebody joked there wasn't much analysis. I said I can't really analyze because I don't follow it. But my view is, I said it was probably inflation's probably ticking up there among other things. But you guys came down before us, and so you have, I think you're trying to sort of catch back up to where we are to some extent. And I think probably, we're not in sync in terms of our economic fundamentals exactly. So, but ultimately, I do think the U.S.'s rates are headed lower, both on the short end and the long end. I am very much and have been consistently saying, though today's GDP, for example, came out with a revision upward, 3.3% on GDP for the second quarter, I still believe under the surface, we have an economy that's not doing that great.
Mm.
And we have an economy that's heading for recession. So that has kept me bullish on bonds. I'm not so worried about exactly when it turns or how much it turns initially or whatever. I do think you're going to see the 10-year go to 3%, maybe by the end of this year. It doesn't have to be by the end of this year, but maybe. And ultimately, next year is going to be a rough economy, in my opinion. I call it a global bust. And in that, I think you can see the 10-year all the way down to zero. So I'm contrary
Mm.
to say the least. But I am not in the camp. I know there are a lot of people that look at last fall and say, oh, the Fed can lower rates, can cut rates, but the long end's going to go up. And I know that's a big story around Wall Street. I don't believe that at all. I think you've seen Basically, I'm more focused on the 10-year because that's what loans get priced off of, mortgages get priced off of. But even the 30-year will ultimately fall. It may be stickier to come down initially, but ultimately, I think all rates across the curve are going to come down. And even the corporate bond market for at least a little while longer is going to do okay.